And the markets are back from a holiday in a sour mood. Talked last week about investors getting trapped because we were going to have event risk on Friday while the markets were closed for the Good Friday holiday. Bit unusual. Typically, you get a little bit of a half day at least for people to adjust when there's event risk. That was not the case this go around. We had PCE numbers that came out exactly in line with expectations. No big news there. But then we had a speech from Jay Powell that was a lot less dovish than previously thought. And the markets are now in a bit of a rough shape as we get started here this week. But there's lots and lots more macro event risk on this calendar in the days ahead. And that's what we're going to look at here. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And what we're going to do here is take a look at some of the critical event risks that are coming at us this week. We have a loaded calendar with various announcements here, but they fit broadly into two buckets. So first we have the U.S. bucket, and it is very full. There's all kinds of event risk on the calendar there. And then we have the Europe bucket. And there we have another big run of event risk that really sets up to put in front of us the dichotomy that should be defining for these markets and defining for the price action that we are looking at here. So this is what we are going to focus on here today. And really the first thing that we are going to do here is sort of go a little bit out of order, a little bit out of chronology here, and do the whole U.S. bucket first, and then do all of the Europe bucket next, then bring them all together and see if we can get a sense for what all of this looks like when you put it all together as a trade idea. Now, bit of stage setting. Here's the S&P. This is a chart we should be very familiar with at this point. The S&P in the blue there as a kind of barometer for overall risk appetite. We likewise see in the green there the forecast that the Fed has for rates. You can see there they're baking in 3 rate cuts for this year. That's what they said in December of last year and confirmed at the March update of the forecast just a week and a half ago at this point. And in the gray is the number of rate cuts that is being priced in by the markets as reflected in Fed funds futures. So the key here, and we've been talking about this extensively, of course, for quite some time, is where the market is relative to the Fed. And what we find is that from about the middle of last year, when the number of rate cuts that's priced in for 2024 reduces, stocks don't like that. When it builds back out, that's where we start to get the rally. But even deeper here, the key difference that the markets seem to be looking at is the spread between where the Fed is and where the markets are. And so you can see here that as these rate cuts stop building, the S&P stops and goes into a digestive range. And when we begin the new year, what seems to really take over is this idea that the Fed is here and the markets are here. And so the money, according to the markets, is going to be much cheaper going forward than the Fed has it guesstimated, because the Fed wants 3 cuts and the markets are looking for something closer to 5 or 6. Then you get hot US economic data that starts to push this back. But as long as it's going this direction and the spread between the market and the Fed still favors cheaper money, or at the very least, as long as these things are in line, you still have a relatively supportive story for stocks here. And that, of course, makes sense, because the reason that this is getting hemmed in is not because inflation is running more rampant, although it is a little bit hotter, but it's because actual economic data on the business cycle is coming out better than expected. Here's the Citigroup index that tracks U.S. economic data surprises relative to what is actually coming out. And you can see here that the data is increasingly surprising on the upside as we get into the start of 2024. There's a bit of a cool off, but generally you're above zero, which means that you're surprising higher. And so as this accelerates, not surprisingly, the stock of rate cuts in the system, at least as far as the markets expect them to occur, is diminishing. You get, by the time you get into February going into March, you get to something of an alignment here, where the markets and the Fed are about in line. And we can see here that that's okay. Stocks can keep rising in that environment because, again, we're in a space here where the economy is doing well. These rate cuts are coming off the board ostensibly not for bad reasons. The economy is, in fact, saying these outcomes are stronger. Where this becomes a speculative headwind is when the Fed is more dovish than the markets. And the markets, as they said here, money is going to be cheaper than the Fed says, risk on. They are starting to seemingly get to a place where they're saying money is going to be more expensive than the Fed thinks, risk off. And indeed, at 57 basis points as of today, we are on the hawkish side of the Fed with market expectations. So 50 basis points are fully baked in. That's a pair of cuts. But when we look from there, we only have 7 out of the next 25 basis points baked in. So a mere 28% chance that we're going to get that third cut. And so now things get a bit more circumspect. You can see the S&P now has stalled. It's a little bit more overt in the NASDAQ, which has been standing still for about a year, or about a month rather, excuse me. It's certainly not about a year, but has gone nowhere since the beginning of March. The S&P, which encompasses a much broader, less kind of singularly tech tilted selection of stocks, we've seen rotation be able to give us this last leg here. But now, again, once we get to the restrictive side of policy expectations, progress has stalled. And against this backdrop, we're going to get another big run of U.S. macro data this week. It begins with the service sector component of ISM. We've already seen the manufacturing side, and that was actually the big piece of news that we saw hit the markets today. We can see manufacturing here unexpectedly returning to growth mode. Expectations were that the number would come in at 48.4. It actually came in at 50.3, much hotter than expected. And ISM surveys, of course, work in the same logic as other PMI data. And so 50 is standstill, above 50 is growth, below 50 is contraction. And the further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. What we're seeing here now is a situation where we have not only a number that is better when it comes to the direction of travel. The expectation was that we'd go from 47.8 to 48.4, so contraction would be slower. No, actually, we've returned to growth in U.S. manufacturing, which is, of course, very good news for the economy, but also an inflationary sort of story. In fact, if we look at where the price index went, the expectation was that we'd get it somewhere in the low 50s again. It came out at 55.8. That's the highest that we've seen the price index for the manufacturing sector since July of 2022. We still have the service sector in front of us, and that, of course, is going to be even more impactful because the service sector is a much bigger share of the economy. The expectation here is that we're going to be at standstill, 52.6. So growth at a rate that is in line with what we saw in the prior month. But, of course, the key here will be, do we get another major upside surprise also in the service sector? And then secondly, when we look at the internals, do we get a jump in the price component in that story? Because if we do, if the economy is moving faster on the service sector, which is about 70% of the overall economy, manufacturing is only about 20%, and the rest, give or take, is ag. And of course, I'm rounding here. But if 70% of the economy is growing much faster than expected, well, then we're in a place where the Fed is not going to be in a position to cut rates very quickly. And the slide that we see here in these gray bars moving higher is probably going to continue. And if that occurs, well, then we probably see stocks, if they continue to not like that kind of a thing, we probably see stocks wobble. Now, that's only one thing. Next, we're going to have the JOLTS job openings data. Here, we're expected to dip down a bit to 8.74 million job openings. That would be, of course, a welcome sign of progress. The Fed has been attempting to squeeze this down as a way to help curtail inflation. The biggest issue for them by far has been the inflation that's been locked in labor markets during that hiring spree on the first round of rehiring after COVID, where you had significant labor shortages, as much as 6 million workers. That's been worked down significantly now, but not really through layoffs, though that has been a little bit of a contributor, mostly through falling job openings. And so when you look at that, 8.74 would be the lowest reading that we've had on this in quite a long time. October of last year would be the last time that it was this low. And before that, you'd have to go all the way back a good way, all the way back to March of 2021 to get comparable numbers, where we got down to about 8.4 million. So we're looking at a situation here, of course, where job openings are still relatively elevated compared to history. We can see that before COVID, we were somewhere from 7.5 to 6.5 million, give or take. So call it an average of about 7-ish, maybe a little bit higher. And of course, during COVID, it cracked as low as 4.7. And on the way back out of COVID, we can see where that rapid hiring is taking place. We got as high as 12. If we continue to see some progress on the downside here, that would be encouraging for the Fed, and maybe reinforce the case that they do still need to cut rates to some extent. But if this were to move higher and surprise higher, that with the vigor in the economy that we've seen, then you would be in a situation where the Fed again would get pushed away from easing. Thereafter, we get the private sector estimate of jobs growth, a pickup expected here. This is from ADP. The increase from 140 to 148K. This is not generally a good precursor to official figures, but markets do look at it. They do react, and so it's worth looking at. But it's those official figures that are the main event this week. And here we are looking for the unemployment rate to come in at 3.9. We're looking for job creation to come in at 2,000. And so, or 200,000 rather. That would be a step down from 275 in the prior month. But again, as we've just seen, U.S. economic data still is tending to perform better than expected. And what we've seen as a sort of telltale signal here, it seems to have some meaningful indication when this index moves through its 20-day moving average. 20 days is just about a month. So if you figure there's 5 days in a week, 5 business days, 5 market days, then, and there's about 4 weeks in a month, 4 times 5 is 20. Obviously, it's not exactly 20. Some months it's more or less, but this is a sort of broad-based baseline. And so what we see here is when it tends to push through the 20-day moving average on the top side or the downside, so for example, here, 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 it tends to have some follow through in that direction. And what we're seeing here is we've pushed through that again, because again, we've had a round of economic data that's been a little bit better, all of which is encouraging of a Fed that is standing still and waiting rather than a Fed that needs to rush and cut. And so we see there, certainly, it seems like, a tailwind for the US dollar. We can see that as rate cuts have diminished out of the forecast, the US dollar has done well. When this initial round of rate cuts diminishing occurred, the dollar rallied. As it stood, the dollar corrected. As it begins to move into a less dovish direction, the dollar is extending gains again. It's also interestingly become supportive for the yen, and that's a very interesting story here indeed, because the yen tends not to do well when interest rates are higher, but it does tend to do well in periods of risk aversion. And with stocks getting wobbly, one reason to think that perhaps they are looking at something that is a deeper pullback is the yen is starting to find signs of life, even as rate cuts diminish, which seems to suggest that rate cuts diminishing are a risk-off catalyst with scope to weigh on stocks if we keep going in this direction. And that's the US part of this story. In the European bucket, the focus is going to be on CPI data. And we're going to get numbers out of Germany as well as out of the Eurozone. For the Euro area as a region, the expectation is that we're going to hold at 2.6% on headline CPI. But that really isn't the big story here. When we start to unpack what goes into it, German numbers seen coming down from 2.5% to 2.2%. That's the largest economy in the Euro area, but also the one that's been lagging lately. So maybe that's not the biggest part of the story, some might argue, because, of course, other economies have been doing better, and that's how you get a 2.6 steady number overall, while Germany's number comes down. But when we look at core for the Eurozone, it's expected to come in from 3.1 to 3%. And that is where things get interesting. If we look at the makeup of CPI most recently in February, it continues to be the kind of thing where discretionary spending, in particular in hospitality, restaurants and hotels here has taken over as the main catalyst. And food, which the ECB doesn't have very much agency over, these remain the main reasons why inflation is as elevated as it is. And if we were to strip that out, we'd be better than the ECB's target as far as the path forward. And so what it looks like then is the ECB has very few reasons at this point not to begin cutting. Because those areas where there is lingering inflation are those areas that are the most amenable to economic weakness when it comes to restaurants and hotels. And of course, the Eurozone just recorded its ninth month in contracting economic activity, if we look at the PMIs, albeit at a slower rate. So the contraction has slowed, but nevertheless, 9 months of shrinking economic activity is not exactly a clean bill of health. Food inflation has significantly declined. It was a contributor of over 1% even in recent months, or over 100 percentage points. Then it got to 90, then it got to 80, and of course, most recently here we can see it got to 54. So we're looking at a situation where that's diminishing and is likely to continue to diminish as global food prices filter into this equation. We've talked before about the transmission lag being as long as 7 months from falling global food costs, which has been something that's been ongoing for a while. And when it actually shows up in CPI, so this has legs to continue. We can see here in the purple is the food cost component, and it's been steadily declining. It was very dominant, we can see, at the beginning of last year and through last year, and now has been squeezed down considerably. And so as we look at this, the case for more imminent ECB rate cuts becomes more acute. We can see now the markets are pricing in 87 basis points in cuts, which means that at least 3 cuts are in the forecast, and we are very, very close to having that 4th rate cut baked in. In fact, if we take a look here, that's 13 of the 25 basis points in a 4th cut that's priced in. So 52% chance that there is a 4th cut. And if this data endorses this idea, then the euro might find itself in trouble. It's already sinking against the US dollar and might have room to continue doing so. If we look at the way that the policy curve looks like here, we have the first cut fully baked in by July, the second fully baked in by September, and we're almost there on the 3rd, and we're almost there on the 4th. So by October, going into December, definitely 3 as far as the markets are concerned, and we're a mere 4 basis points away from 4. So the markets are very clearly looking at much more easing for the ECB here, 87 basis points as compared to 57 basis points, a full 30 basis points less for the Fed, which seems like it's going to give the US dollar still more room to keep rising. And that is macro money for today. As ever, we are here Monday through Thursday every week, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what is likely to follow. I'm back on with Chris for Futures Power Hour on Friday, on with Tom and Victor for First Call Sundays, and writing for the News and Insights portion of tastylive.com. I'm also sporadically opining on the platform formerly known as Twitter, at Ilya Spivak. Thanks very much for joining. See you tomorrow.